Hello, welcome to Unit 4, Section 5, the last section, the Finance Unit. We're looking at analysing financial performance. There's only one objective today, and we're going to use the data on revenue, costs, profit and loss account and cash flows to analyse business performance and to make business decisions. Now, there aren't many key terms today because essentially what we're doing in this final section is pulling in all the work that we've done so far in this section. So like I said on the learned objectives, we're going to look at revenue, cost and profit and loss, cash flow, to sort of see if we can sort of pass comment upon how well a business is performing. Okay, so that's what we're doing in this section. So how well is business performing, and how well is it meeting its objectives? Okay, and this outlines the sort of kind of things that we're going to be definitely looking at in this section of work. So looking at cost, profit, break even, cash flows, gross and net profit, cash flow forecast, average rate of return, in order to pass judgment on how well a business is doing. And then from analysing all this data, a lot of businesses can then sort of plan ahead and look at their strategy, and all the information in the previous slide, it gives a business sort of a whole interconnected view of how well they're performing. Okay, so you could look at maybe one document in isolation, but without taking into account the other documents, maybe you're unable to give a sort of a whole view of how well the business is doing, and as a business, how you can kind of move forward from that. Now, there are a few things to sort of consider when you are looking at all the sort of financial performance of a business. You have to look at trends. There are always going to be blips in certain quarters, in certain months, in certain weeks, in certain years, and so on for reasons out of their control. However, if there is a series of perceived blips, then that you probably see that is now a trend. So you really want to sort of see how things are moving in their financial data. It's always really important to consider the context. Okay, so it could be like maybe a farmer is looking how well their crops have performed over the course of a year, but there might be sort of a bad amount of profit because you've got less revenue, but there might be poor weather which has led to the crops not growing properly. Maybe there is a slow economy. So, for instance, now a lot of businesses are probably going to have a bad year because of coronavirus. So it's important to take that into consideration when thinking about how well the business performed this year. You also maybe need to consider how well similar businesses or your competitors are also doing. Okay. Now, not just looking at the financial data, but there's also other things that you should probably take into consideration when passing judgment on a business. Okay, so you can look at their qualitative information, okay, and then non-financial data. Okay, so qualitative data is information that can't be measured. It might give an indication of how well the business has performed. Non-financial data can be measured, but looks at factors that are not directly concerned with the financial aspects that are listed on the previous few slides. Okay, so you might want to consider how happy your customers and how happy your employees are. Okay. Also want to consider the environmental and ethical impact that your business is having. Okay, and in general, consider your business's reputation. Now, this can be hard to measure, but it's always worth taking into consideration when trying to pass judgment about how well a business is performing. Now, you might want to consider these pieces of data. So the market share. So how much of a certain market do they have? Looking at how well you compared to your sales targets. And has the business improved this efficiency? Has it become more productive? Okay. So what we're going to do now is we're going to look at one scenario. Okay, and there will be some other scenarios that you can also have a look at in Teams. Okay, so Walson Limited supplies furniture to businesses throughout the UK. It manufactures a range of tables, chairs, desks, and sofas suitable for offices and shops. However, over the last 2 years, its sales have declined and have lost market shares to its competitors. As a result, its profits have fallen to 12.2 million. 9 months ago, the company's manager took a decision to offer its customers an increased period of trade credit. Now, if you remember in the first section of work, trade credit is the amount of time that customers that are business to business have to pay their bills. Okay, so when a farmer maybe goes to buy feed, it doesn't pay for it right then and there. It will receive a bit. He will receive a bill in a month or 3 months to go and pay that off. Okay. So as I said, they've agreed that there's going to be a longer period of trade credit. They've launched a brand new environmentally friendly and ethical range of furniture. Okay. So as you see below, there is a table that outlines the cost and revenue over the sort of first 9 months. Okay, so sales revenue is relatively high, and the total costs are also quite high, but does leave sort of with a relatively healthy amount of profit for compared to the sales revenue that it has. Okay. However, the real issues may become when we consider the cash flows for that 9 months. Okay, so if we look at the top two lines there, the cash inflows and the cash outflows. The cash inflows are the money flowing in, the outflows are the money flowing out, so like the cost and the expenses. Now we can see by just looking at that the outflows are much greater than the inflows. Okay, all right. So if we look at the third line down, then the net cash flow. Okay, which is the difference between the inflows and the outflows. If we start to look at a trend, we notice that the next cash flow is getting smaller. So the gap between the outflows and the inflows is getting much smaller, and it is moving in the right direction. And maybe if we look at months 10 to 12, it would maybe be the inflows are higher than the outflows. Okay. However, it could be an issue for concern, because in the end the business ends up with sort of a negative closing balance. Okay, so maybe it's going to struggle to pay its bills from day to day. Okay, so even though maybe the profit is relatively healthy, there are issues with cash flow within this business. Okay. So this slide sort of explains a few of the things I've spoken about. So the business is likely to be happy due to the rise in profits. However, the cash flow situation is worrying. But then if we consider sort of the other factors that we discussed, okay, they are launching a new range of products, okay, and ethical products of those, which might lead to a much better reputation, for instance. So that information is worth taking into consideration, despite the fact that there are issues with the cash flow. So in general, really, the picture is looking quite good for the business. Profit is moving in the right direction, but there are issues that do need to be addressed, and that is the general opinion we can pass on this business by analysing all the data that we've got. Now in Teams, I've placed 2 additional examples that I'd like you to have a look at and have an understanding of. And then there are some theory questions I want you to do, and an example that I'd like you to also pass judgment on. Okay, thank you very much.